Having conviction in what you own, I think, is really critical during times of volatility. You know, if you don't have conviction, it's very easy to get bugged out. And differentiating between noise and reality is two different things. So the noise is as volatility increases and markets, you know, have down days. Of course, there's many people who come out of the woodwork saying, "Oh, this is the end of the bull market. It's over. The world is ending," and etc., etc. Well, you know, why don't we cast back to 2009 when everyone was saying that, and that was an extreme example. It was the best buying opportunity in the world. So the stock market is an interesting place. I was reading the other day, somebody said if you somebody offered you a Ferrari at half its retail price, you'd say, wow, that's an amazing deal. But with the stock market, if a share price that you're happy to, if the value of a company that you were happy to pay drops 20% due to a market fall, a lot of people say, oh no, I don't want to buy now, when it's a whole lot cheaper than what you were prepared to pay a few weeks back. So I think conviction is the key. So I look at the companies we own. Unless there's a change in the thesis, the fundamental reason that we invested in the company, every time we buy into a company, we ask ourselves, if the price comes off due to market concerns, are we going to buy more? We look at that as an opportunity, not as a problem. So again, can't state it enough. It's all about having conviction. I guess there are two main sell disciplines that come to mind, and I do think, you know, it's very easy to buy a stock, so the ability to sell a stock for most people is infinitely more difficult. So let's look at those two different sell disciplines that one needs to have. One is when a company reaches your target valuation, and you have to be honest about that and say, well, you know, we really think it's full here, and the risk reward is not compelling any longer, and therefore we're not going to try and convince ourselves because it's got momentum, we're just going to keep owning it. So we're very disciplined on that. Once we feel an investment in a company that we have has really exhausted its risk reward dynamic, we will sell. And you know, if the next person that buys into the company makes 10%, good luck to them. But we feel we've made a better risk-adjusted return from where we bought it to where we sold it. So that's the first piece. The second piece, and what's very important, is where a thesis changes or you've just got it wrong. So, you know, to give you an example, we owned a company called Sabre a long while back. And what we didn't quite appreciate is that they had been underspending on CapEx for a period of time when they really actually needed to have increased their spending on CapEx. And they had an earnings result which came out, the stock had performed reasonably well, and they had an earnings result that came out that highlighted that underspend on CapEx. And to us, what that showed is that, you know, that it was going to impact their cash flow dramatically going forward, as they were going to have to ramp up that spending, and then you had to hope as an investor that their competitive advantage was going to be kept alive. We just took the view that the thesis had changed materially for us, and we immediately exited the position. So what we don't want to do is spend any time trying to nurse a wound that may never heal.